So one of the things we're going to talk about tonight is we're going to talk about the hidden secrets to unlocking the market patterns, the secrets that will help you make better decisions, that will help you make smarter decisions in terms of when you buy and most importantly, when you sell. And if you knew exactly when to buy and you knew exactly when to sell, how much easier would that make your business? If you knew the exact right time to buy and the exact right time to sell, you would never really make mistakes. Now, you're never going to get it exactly right, okay? Because this is not an exact science. But what we're going to talk about tonight is something that is so predictable that you're not going to believe it by the time you're done with this. And it's not just me saying that it's predictable. I'm going to show you and prove to you how predictable this really is. But first, I gotta talk a little bit about somebody that I absolutely follow, that I love, that I've always listened to, and that is, he's not really my friend, but we're going to call him my good friend, Warren Buffett. Warren Buffett knows a thing or two about the markets, but Warren Buffett is also a very simple man. The way he does his business, the way he formulates everything he does is on simple, basic, fundamental principles. And Warren Buffett believes very wholeheartedly about what we're going to talk about tonight. And I know there's going to be some people that watch this that say, yeah, but this, or yeah, but that. But you really just need to kind of peel the onion a little bit deeper and understand that he absolutely follows these principles. And these principles you're going to learn about really fall right into what Warren Buffett often says. And what does Warren Buffett say? Well, right here, Warren Buffett says these three things. To be successful in investing, you have to do three things really well. Okay, first, you have to buy low. Now, we all know that, right? Especially if you're in real estate or no matter what you're in, buying low is always going to help you make more money. It's going to always be, in real estate especially, the one thing that's going to lock in your profits before you even get started. Because if you can buy low and you know how to do this consistently and persistently, buying low is going to be the secret sauce to success. But the second thing Warren Buffett says is he says, you have to sell high. Now, we're going to talk more about this in a moment, but this seems to be the sticking point for a lot of people. You see, as an advisor, I was a high-level advisor for many years, and I can't tell you how many times we would make suggestions to sell a particular stock or a mutual fund or an ETF, and the people would not want to sell it because they're attached. We get emotionally attached to things. We get stuck in habits and patterns, and those patterns are sometimes the downfall. But those patterns are exactly what we're going to talk about tonight. We're just going to talk about them in a different light. So Warren Buffett says you have to buy low, rule number one. Rule number two, you have to sell high. And rule number three is the most complicated one to really understand. And Warren Buffett says you don't lose money. So buy low, sell high, and don't lose money. That's a pretty easy strategy, wouldn't you say? So if it's so easy, why doesn't everybody listen to it? Well, a lot of people understand the buy low, and everybody thinks they understand buying high, but nobody really understands the don't lose money part. It's sort of like Bed Bath & Beyond, right? We know the Bed Bath & Beyond stores. We understand what the bed is. We understand the bath part, but what is that beyond thing? Well, that's kind of like Warren Buffett's principles here. But let me sum it up and make this very simple. And then what I'm going to do is I'm going to prove what Warren Buffett said is the truth. You see, the buy low part is something that we do quite often, and sometimes we do it without even knowing we're doing it. So if you're contributing money to a 401k, if you're systematically contributing to any investment account, and when I say systematically, what do I mean? I mean every week, every other week, maybe monthly, any type of systematic investment into the markets, what you're essentially doing, and we are talking mostly about stock market right now. We're going to transition into real estate throughout this entire training, and I'm going to kind of show you how to correlate the two of them and how to bring them together so that they really can be looked at in the same general principles. But for right now, we're talking about the stock market. All right. So buying low is happening in every systematic investment because the stock market goes up, goes down, goes up, goes down. And it does this in either big patterns or really small, tight patterns. The bigger patterns are the easier one to predict, which we're going to talk about a lot. The smaller ones, not so much. But if you're buying every single week, you're buying in these patterns. Some are going down, then it's going back up, and you consistently keep buying. But over a long period of time of doing that strategy of systematically buying into the market, you are going to reduce the cost that you're buying in. Now, this also works in real estate, the exact same thing, except for you can buy into mutual funds, stocks, bonds, and ETFs a little bit cheaper than you can buy systematically into real estate. But really, if you could buy real estate, if you had unlimited funds and you had a lot of money to go out there and buy real estate, you could do the same thing. You could systematically buy real estate on a very rhythmic pattern and follow that. And by doing that, you would decrease your average cost of buying. So that is the buy low. You're all doing it already because you probably have IRAs, you probably have 401ks, 457s, any employer-sponsored plan. The sell high part, let's talk about that. In theory, selling high seems really simple, doesn't it? Right? We all know that when the market's high, you should sell. Okay, when your real estate values are high, you should sell. When anything, for the most part, is high, that is the best time to get out. That is the best time to sell. But so many of us don't do that. I mean, just start asking people. Start going around and asking people, are you selling? Did you sell your stocks? Did you sell your mutual funds? Did you sell your real estate? And most people are going to say, no. I think it's still got a long way to go. My financial advisor said the markets are going to keep going up and you got to be in it for the long haul to make money. Now, I want you to focus on what I just said. You got to be in the long haul to make money. Very true statement. So Warren Buffett's sell high can be applied in several different ways. Okay, sell high, you can wait the long haul and sell someday down the line, much, much further down the line, and you can probably almost always make money. Over a long period of time, if you just stay in the game, you will make money just by the nature of the appreciation. Is that a fair statement to make? It is. Okay, but a lot of us, we want to be looking at this in a more rhythmic pattern. We want to always look at where is the high point to sell. Well, everybody thinks sometimes when we're in a bull market, and all a bull market means is we're in a market that's going up. A bear market is a market that's going down, just to get some of that stock market lingo out of the way. But right now, we have been in a bull market, an upward market trend since the Great Recession of 2008. Okay, so since 2008 until now, we have just been going up. But how much further up can it really go? Well, that's the million-dollar question, and that's what we're going to talk about today. Because a lot of people want to think that it's going to keep going, and it just might keep going. But I'm going to tell you without any shadow of doubt, it is eventually going to come down. The stock market always goes up and always comes down. It has to. It's actually healthy. As unhealthy as it seems like when it's going down, it is part of the natural cycle of what makes everything work. But right now, all I'm going to tell you, and we are right now in April of 2019, it is my opinion that the markets are at a very high point. Now, there's an awful lot of information that goes into explaining that, and I'm not going to get into that for today's training, but we are at a high point. So the smart thing that Warren Buffett says is to sell high, right? So that's what you should be doing. You should be really analyzing and looking at what you're holding, what stocks, bonds, mutual funds you're holding, and you should be looking at, should I sell it now? Because what happens when you sell? Really nothing. A couple things are certainly happening. Number one, when you sell, that money typically goes to a cash account and it is safe. You locked in your gains. The other thing you have to be careful with is sometimes in stocks, if you sell, that creates a taxable event, but not in employer-sponsored retirement plans, not in 401ks, not in IRAs. Those are tax-deferred vehicles. So if you're in any of those, there is no reason why right now shouldn't be a time you should look at selling, because we are at a high point. And we're going to get deeper into why and the mechanics of that in a moment, but I just want to get your mind thinking about how money really works. So we buy low by systematically buying in, and we should always be looking for where that high point is, but we never know. You know, we always go with the conventional financial knowledge, what we've been taught thus far, what we've been taught in our life, what we've been led to believe. That's what we go off of. But I want you to start really focusing in on why you're getting that information, and I'm going to cover that in a few slides. But that's Warren Buffett's 1 and 2, buy low and sell high. But then Warren Buffett says this funny little one. He says, don't lose money. Well, that seems pretty complicated because, sure, he's Warren Buffett. He's got billions and billions of dollars. He can do things that I can't do, that the average person can't do. No, he absolutely is saying the truth. And all you need to do to not lose money is apply rule number 1 and rule number 2. If you buy low and you sell high, you can't lose money. So why is it that so many people lose money when the market turns down? Why is that? It's because they don't sell. They don't know when to hold them and when to fold them. And I know that's not what he was talking about, but that is the perfect analogy for this. When to hold them and when to fold them. If you could just apply what Warren Buffett says right here, you would always make money. But how many people do you know, or how many times have you been able to always make money? And if you're one of the few that has, great, you're doing something right. You're following these principles. But now let's get into the mechanics of Warren Buffett's rule number 1, rule number 2, and rule number 3. Buy low, sell high, and don't lose money. So what you're seeing on the screen right now is you're seeing a chart. A very boring chart. You've seen these before. You've probably looked at them. You take the paper, you spin it every which way. You're like, I don't know which way this goes. But all it's there to do, and I don't want you to get caught up in the numbers. I don't want you to get caught up in the returns. I don't even want you to get caught up in a whole lot of this graph. This is the S&P 500. Okay, this is the Standard & Poor's. It's a historical composite. It's been around since 1871, which is longer than any of you watching this video have ever been on this earth. So I think it's pretty factual and pretty accurate. Now, the only things I want you to really look at, and I want you to really focus on this. I want you to look back to 1877, and I want you to start following and looking at those patterns, okay? Because the market goes down, then it goes up. Then it goes down, then it goes up, then it goes down, up. You get the drift. I think I don't need to say that a whole lot. And you can follow that straight on through. Now, every time it goes down and up, and I need you to look for the bigger pits and valleys, okay? The troughs, we call them all sorts of different things. But for tonight, I'm not going to get all stockbroker or technical as an advisor. I'm just going to call them. I want you to look at the highs, and I want you to look at the lows to keep this super simple. If you sat there and you blew this graph up in any time frame, if you just blew this graph up in any time frame, what you're going to see is you're going to see that there is a very rhythmic pattern forming on this. And what do I mean by that? Well, I mean that on a very predictable basis, the market goes up and the market comes down. Now, it's not a perfect up and a perfect down. There's some, some bumps in the road, if you will, but just look at it from when it's up and when it's down. And then what I want you to do is I want you to really kind of look at it, and I want you to kind of just focus in on how long of a period of time is it in between those highs and those lows. Now, what I'm going to tell you is an average. I'm not going to break it down into each one, but the average is every 5 to 10 years. More realistically, every 7 to 10 years, there is a high and there is a low. And let's just kind of fast forward up until some times that we may remember. How about the early 2000s, which you can see right on there. You can see where that one was. Now it's really small. Okay, you can kind of see where it was up, and that's 2000. Okay, it was up 666%. And over the next 3 years, it fell all the way down. A lot of people lost a lot of money during that period of time. But from that period of time to when it went back up in 2008, how many years is that? It's pretty simple. It's 8 years. Okay, so now in 2008, we all remember what happened, right? The market fell down steeply. See how steep that line goes down? That's what was so severe about the Great Recession. Wasn't so much the losses, because the losses that we faced there, 59% to be exact, those losses where they went down, those are very similar to other market drops, okay? But other market drops maybe dropped for a period of 2 years or 3 years. This one happened just like that. It was like a complete flush. The market just, almost like somebody pulled the plug in your bathtub and all the water rushed out. That was what happened in the market. And I got news for you. That's going to happen more often than you think. And it's going to happen because the way that the markets are set up today happens much quicker. We live in a digital age, and a digital age means things happen quick. Back in 1800, back in the early 1900s, things didn't happen as quick. They didn't have computers running trades. They didn't have stop losses that when they triggered, it was like dominoes going down. It was a slower reaction. But even whether you compare the Great Depression and all those years after that, and the highs and the lows, to where we're at now with the highs and the lows, the pattern is the same. The pattern seems to always mimic a 5 to 10 year pattern. But I don't want you to really get so caught up in that 5, because that's more of the rare number. I want you to focus on the 7 year and the 10 year, okay? The 7 and the 10. So if you knew in a very predictable way that the market was going to go up and the market was going to go down every 7 to 10 years. Would that help you make your decisions? Would that help you to understand when to buy and when to sell? Well, what does Warren Buffett say? He says, buy low and sell high. So if we look at this chart, it's very easy to go back in time, right? Very easy to go back in time and say, ooh, I would have bought there. Ooh, I would have bought there. It's almost like, that Family Guy episode, ooh, piece of candy. Ooh, piece of candy. It would be super easy if we could just go back in time. We would know exactly what to do. But unfortunately, that's not how it works. So now let me go one slide ahead here. And now we're going to talk about the Dow Jones Industrial Average from 1900 to 2014. This one actually tells the story a little bit better because the Dow Jones is easier to see it because it's a shorter period of time. So now we can really kind of look at that thing and we can see where we're at. But I want you to really look at where it is at the very end. The future, if you will, or the present time, the now. I want you to look at that and I want you to see kind of what's happening. See those couple little squiggles where it's kind of going up, down, up, down, up, down. Well, guess what? That was last year. That was last year. Now I want you to look back in time and I want you to look at all the other periods when it was getting to the high point. See a little bit of up, down, up, down? Okay, that's resistance. That means the markets are fighting to keep gaining ground. They're fighting to keep going up. And when that happens, that's some signs. But there's so many other signs that don't matter. If you really want to get good at market patterns, there's way more you need to learn than I can teach you in this 45-minute long training. There's just so much more. But what I need you to understand is that simple concept of what Warren Buffett said. Buy low and sell high. And then I need you to kind of layer over that the market patterns that we just discussed of every 7 to 10 years. Every 7 to 10 years, the market goes up and down. Well, when the market's down, what do you want to be doing? You want to be buying, whether it's real estate, whether it's anything. I don't care if it's stocks, bonds, ETFs, gold can be played, but gold will have an inverse relationship. You have to understand a little more than what I'm letting you in on, but let's just talk about stocks and let's talk about real estate. When a market goes down, those are great times to buy. And when the market comes up, well, they set up to start selling those positions. And really, what does it come down to? It comes down to you creating some rules of engagement for your business. If you're a stock trader, well, why don't you just start looking at those rules and say, okay, when I make 20%, I'm going to sell. When I make 40%, I'm going to sell. It doesn't matter your number in real estate. When I make 20%, I'm going to sell. And I know we get so attached to these things. Maybe you bought Apple stock a long time ago and you're like, oh my God, Apple's just going to keep going up. Or maybe you're one of the new lucky ones that got into Amazon and you're like, that thing's never going to go down. Of course it will, you guys. Of course it will. Folks, I don't care what you own. I don't care how good you think it is. It will go down. It will follow the patterns. Some might follow them and go down more than others. I'm not talking about the semantics behind it. I'm simply trying to help you understand that there's 3 basic principles that you need to follow: buy low, sell high, and don't lose money. And it's so easy to predict how to do that. And I just showed you with 2 graphs, the S&P 500 and the Dow Jones. You know what both of these are. Just look at them. Literally look at them. And when you're done with this training, Google these same charts, start blowing them up, shrinking them down, and start counting the years in between. Because you know what you're going to find? You're going to find that exactly what I said is about right. So what am I getting to with this? Well, I'm getting to the simple fact that if you are watching this right now, and it is somewhere around 2019, because this training will obviously go much further into the future, you need to understand that we are at a high point. And if we're at a high point, what would be a smart thing to do with your stocks, your retirement, your bonds, maybe even some of your real estate? It might be the right time to sell and lock in some of those gains. It might be the right time to fold them and lock in those gains, because when you lock in those gains, you can't lose money. But I'm only getting warmed up. You see, even though you sell those and now all of a sudden you locked in those gains, that sounds great for the moment. But then all of a sudden, what are you going to be in? You're probably going to be in a cash position. You're probably going to be having that money sitting in this really safe investment, making very little, and you're going to get bored, and you're going to start wanting more, and you're going to start wanting to make a return. So this is where the tricky part comes in. You might be able to apply rules 1 and 2 and 3, okay? But now you need to make smart decisions as to when the right entry point is. And that's what we're going to talk about next. So this slide represents exactly what you just saw. Okay, the ups and downs of the market. And let's just pretend that that first little up That's where we're at right now, because that's about it. See that short little line going up? We're somewhere in that realm right there. That's about where we're at. Matter of fact, if we were on a roller coaster, some of you are sitting in the front couple seats, and the rest of us, maybe we're sitting in the back. Well, the people in the front seats, guess what? They're already looking down, and their heart's starting to beat. They're getting nervous. They're just getting ready for that big rush, that big drop. But the people in the back are still looking up at the stars in the sky and saying, "Ooh, pretty birds." And they're just saying, "This is so awesome," because they're just going up. So you've got some people that are seeing down. Who are those people? I got some news for you. They're the wealthy. Okay. The wealthy are exiting the market right now. Big money is exiting the market right underneath you. You don't even know what's happening. It's almost like an underground river running underneath your feet. That money is rushing out of the market and finding safer places to go, while you are staring up at the sky, watching the butterflies, watching the birds, and wondering when this ride is going to get really exciting. And it's going to happen soon. And I use this analogy. I talk about a storm. How many of you live in an area where there's a storm? Okay. You hear about it on the news, the radio. Maybe it's a snowstorm. Maybe it's a tornado. Maybe it's a flood. Whatever it is, you hear about it on the radio, right? And the very first thing you do when you hear about this is you panic. Then you go into emergency fight or flight mode. At that point, you start preparing. Whatever the storm is, if it's a snowstorm like we get here in Buffalo, you rush out, you stock up the fridge, you fill the car up, you make sure the snowblower's got gas, you hunker down and you prepare. That's what we do when there's a storm, like a weather-based storm coming. We prepare. So right now, if that's where we're at, you need to start getting prepared. So how do you prepare? Well, it's just like being on the roller coaster. You need to understand what's coming, and you need to understand how to play what's coming. So that's what we're going to talk about here. So let's just assume that that group of people is all of us. All of us. I'm going to call us the 5%ers, because you know what? The other 95%ers, they're not here. They're home doing something different. Maybe they're watching sports. They're not here learning. You are the 5%. You are the ones that are willing to invest your time, your energy, your money. You're here. You want to learn. And that is why I'm calling you the 5%ers. The other 95%ers, they're watching TV and they're not learning about this. So that is us. We're sitting there. We understand that we're at the top. And if we're at the top, at the high point, Warren Buffett says, sell. So that's exactly what we're going to do. We're going to sell out of the market. Okay. So our money is going to flow out of the markets. And that was that money that you just saw disappear from the screen. That is your money going out of the market. But where does it go? I told you, in cash. Now, the beautiful thing about what's happening right now is you are out, you folded, you've got all your gains locked in. And now the other nice thing is you're sitting at the top. And now what you have is the ability to take a deep breath and watch the show, because this is kind of what the show looks like. You see, the show looks a little bit like this. The markets go down, represented by the red arrow. And the next thing that happens, and this is, let me just explain this. So a lot of people understand that if you buy into the markets and you just hold it for a long period of time, you're going to make money. And I already told you that that is the truth. But the thing that I didn't really mention, and the thing that many of you are not thinking, is when the market does drop, okay, when the whole thing goes down, what happens? Well, first off, people lose money. Second off, people panic. Third, employers have to start laying people off. Fourth, some companies close. Fifth, the emotion kicks in. Whoops. Sorry about that. The emotion kicks in. And then when the emotion kicks in, I want you to think about this, and I want you to think back to 2008. And I'm going to get into this, okay? Because if the theory of buying and holding for the long period of time was perfect, everybody would make money. But here's the reason why they don't. And here's the reason why I don't particularly love that strategy. You see, if you buy and hold for the long period, it doesn't account for some very important things. And I put one of them up on there, but the second one that I don't have up on there is the emotional impact. So when the market goes down and somebody loses their job, at that point in time, sure, they have work, they have unemployment, but that's not enough. When that happens, they have to start making some hard decisions. So it also, in 2008, this happened. They had to start thinking about, okay, I have this money sitting in my retirement, or I have this money sitting in the investments, and I know that that money's for the long haul, and I know that money's going to be okay, even though it doesn't look good. I'm not looking, I'm not watching, my eyes are closed, it's down 30%, 40%. You're seeing that, and you know that if you sell, it's all over. Because if you sell, you lock in those losses. Just like the 5%ers, us at the top, we sold, but we sold at the high point. We locked our gains in at that point. You see, these people at this point, they know that if they sell, they're going to lock in their losses. And it becomes very real. And all that stuff they learned about the long haul, being in the market for the long play, holding out, riding it out, all those things that you heard, those are all real. But at this point, it's a matter of, okay, am I going to lose my house, or am I going to take my money out of the market? Am I not going to be able to put my kids through college, or am I going to take money out of the market? Am I going to put food on the table, or am I going to leave my money in the market or take it out? You see what I'm saying? At this point in the game, emotion kicks in, and emotion is one of the most powerful things in the universe. You see, it's a fight or flight, just like I said. People are going to make decisions that are going to be survival mode decisions. And survival mode decisions do not include wondering about your retirement. They don't include thinking, wow, Apple's only going to go back up. All I got to wait. They start thinking about, how am I going to feed my family? How am I going to make sure my kids keep going to college? How am I going to make sure our cars don't get repoed? How am I going to make sure that my family has a safe place to live? Those are powerful, powerful decisions to make. And those decisions are why people don't all make money in the market. Because when those happen, they sell. And mark my word on that, they sell their positions. They lock in those losses, and it just becomes reality. But then I'm just going to kind of warm us back up, because I just brought us down really low. And that was sad. And I'm not trying to point on anyone's, anyone's issues that they had, because I know in 2008 there was some bad things that happened, and it was a really hard time, and these things were very real. Job losses, just crazy things happened, and they always happen. It wasn't just 2008, but that's what we remember. You see, that same thing happened in 2000. That same thing happened in the prior recession. That same thing happened in the 80s, the 70s, the 60s. Over and over, those same things happened, but our memory seems to forget about those. It's like it disappears, and we only remember the good things. And what are the good things? Well, the good things are what's happening right now, because the market's high. So now what do? What did the 5%ers do? Well, remember, we got out at the top because we knew the market pattern. We knew we were at the top, and we knew what Warren Buffett said: buy low, sell high, and don't lose money. And we did that. And now what we're doing is we're sitting up at the top watching it go down and down and down. And you're never, ever, ever going to be able to predict the top, and you're never going to be able to predict the bottom. So just get that right out of your head. You can't do it. You cannot predict the top, and you can't predict the bottom. You can predict the almost top and the almost bottom, but you can't get it right. Nobody really gets that right. Okay. So what we do is we find a point and a buy-in entry point, and that's when we start redeploying our capital. Now, I know I put your money, all the money we took out on the top, I put it down at the bottom. So now what we're going to do is the next thing we're going to do is the markets are going to go back up. And when the markets go back up, what are we going to do? We're going to start making money, because when we redeployed our capital, when the market was going down, we bought low, did we not? And now, just like every market cycle, the markets are going to go back up. Now, I don't know how, when the market goes down, I don't know how long it's going to be before it goes back up, but that's very easy to see. You see it hit a bottom, it bounces, and then it'll bounce a few times on the bottom, and then it'll slowly start going back up. Now, I did say slowly, because if you think back to 2008 or early 2000s, how fast does the market go down? It goes down super fast. So fast that it almost like every day you wake up, there's a huge drop in the Dow or the S&P. And how fast does it go up? One day you make 2%. The next day you make 3. Then it goes down 2. Then you make 10. Then it goes down 2. Then you make 4. Then it goes down 5. You see what I mean? It goes up, but it goes up so slowly over a long period of time. How long? By now you should know the pattern, folks. If it goes down now, how long is it going to be before it comes back? 5 to 10 years. Okay. Maybe a couple months beyond that, but I don't know. This is going to be a unique time right now. We're in 2019. We are beyond the 10-year mark. How much longer can it go? Well, there's a lot of moving factors, but I would say probably not much longer. And I'm not alone. Google it. There's a lot of people talking about it. And I want you to Google it, and I want you to look at the big ones, the big names. Is Warren Buffett buying right now? Nope. When's the last time you really, really heard about Warren going public about what he's buying? He's not. He's not buying right now because Warren Buffett knows his rules. Buy low, sell high, and don't lose money. Now, Warren Buffett's a long play, but he has the money to wait through that emotional period. He's not losing his job. His employees might be, but he's not. So he can wait that long haul for that big payday at the end. Maybe you can't. Maybe the people you know, they can't wait either. So when we bought low and now we're just waiting for the market to come back, you pretty much know exactly when the next time is. You have to start looking at selling. And again, I just want you to start getting your mind around this. I want you to start thinking about how money really works. And how money really works is very simple. It's following these simple secret patterns. The patterns of the wealthy, the secrets of the wealthy, and what they do. Folks, this is what they do. It is so simple and easy to understand. You just got to wrap your head around it, and you got to get out of your own way and just understand that this is simple. This is not complex. This is not algorithms. This is not arbitrage. This is not those big fancy words you hear about from all the Wall Street shows and all the Wall Street talks that you go on and watch on your favorite money talk show. This is the money school. This is the market patterns. And this is the big thing you need to understand because it is that simple. It really is. But now let me just explain to you one other thing. This is kind of something that I was reluctant to show, but it was something that I felt obligated to show. And I'm going to upset some people in showing this because this is stuff that they don't want you to know. You see, this is really how it works. And I'm going to keep this at a very simple level. How simple? Everything we do is at a 5th grade level. That's where I try to keep everything. So you always hear about the big investment companies, okay, the big ones. And I'm not going to throw any names out there. Maybe it's a mutual fund company. Maybe it's a big brokerage house. And you always hear in pretty much any market condition, they start making claims of returns, right? We have averaged 20% return over the last 4 years. We have averaged 50% return over the last 10 years. You hear these things all the time. Matter of fact, you get brochures mailed to you. Even if you're not invested, you get advertisements mailed, and they show these patterns and they show these average rates of return. I want you to focus on what I just said. Average rates of return. I'm getting all fired up. I'm getting really fired up to show you what I'm about to show you. So let's just assume at a 5th grade level, you all put $100 in the market. Okay. In year 1, you make 100%. Yay. Pat yourself on the back. Big pat. You made 100% return. Year 1, your money went up to $200. You're feeling pretty good. Right now, you're feeling amazing. You might even be thinking, boy, I got this down. Those courses I took, those books I read, those YouTube videos I watched, they're really paying off. But then year 2, you lose some money. You see, year 2, that 200 drops back down to 100. But how much did you actually lose? Well, you lost 50%. Why? Because year 1, you started with 100, you grew 100%, you went to 200. Now year 2, you lost 50%, you're back down to 100. Okay. Now year 3, I didn't make any mistake. That was just a little glitch in the system. I knew that was going to come back up. Year 3, you made 100%. You're like, woo, pat yourself on the back. Awesome. The market went back up. Now you're back. You're 200. All right. Getting warmed up. Start doing your aerobics, getting warmed up, getting ready to go. And then what happens next? You have another down year. And you only lose 50%, but you just made 100%. So no big deal, right? So you made 100%, you lost 50. You made 100%, you lost 50. But somehow, how much do you have left? You have 100. You have $100 left. But how much did you start with? You started with 100. So you went from 100 to 100. How much did you actually make? Now, I don't think anyone on here is really not figuring this out, right? I think this is pretty simple math. You made nothing. You started with 100, and now you have 100. And how many years went by? 1, 2, 3. You can count the years. So really, you didn't just lose zero. If you factored in inflation, you lost more than that. You lost the time value of money, but you really, in your mind, you made zero. You're like, boy, that was a nice little exercise. You know, maybe I don't know what I don't know. Maybe that conventional financial knowledge that they've been teaching me, maybe it's not right. But here's what they want you to believe. And this isn't even what they want you to believe. This is just math. But math spun in a way of marketing. And this is what you see when you get all those reports. This is what you see when you get those advertisements. This is what you see every time you're talking to those advisors and they're talking about the average rate of return. Now, I know some of you are probably already doing the math, but that's what they're showing you. How much did you actually make? Oh, well, you averaged 25%. Now, forget about the numbers on the left. What if I just told you over the last 4 years or 3 years, our investments have averaged 25%. You'd be like, wow, that's pretty good. I like that. I wouldn't mind making 25%, would I? You wouldn't either. I'd love to make 25%. But how much did you actually make if you really ran the numbers on that? Zero, right? Isn't that funny how that works? Isn't that just funny how they tell us that that their investments averaged 25%, but in reality, we really didn't make anything. I just want you, and now you can see why I was reluctant and almost didn't show this slide. I just want you to get your head around what's really going on here and how money really works. So I'm getting to the end of this training, but I want to just recap real quick. And I'm going to go back a couple slides here. So we all understand this, right? These are the markets. And then what the smart money does, it gets out at the top, because that's what Warren Buffett would do. And when the market goes down and bad things happen, and we all know what those are, we start to redeploy our money. And then what happens when the market goes back up? We start to think about our exit again. But that's not the slide I really want to focus on. You see, this slide is, and this is how I'm going to finish this. I don't care how nauseating I get into the details on this. I don't care how much I tell you about what are some of the things to look out for, what are some of the things to watch for, what are the different trigger points of what you should be looking at, like mergers and acquisitions, like interest rates, like the price of oil, the price of everything, watching all those things. Those are all indicators. And I'll give you one other good one. When you start following transportation, okay, and you follow logistics and you follow trucking and all that, when the trucking companies start to slow down, that's a pretty good sign that the economy is starting to slow down. When you see all the big companies start buying up the other big companies and you start hearing about all these mergers and you're like, wow, that's pretty cool. XYZ company just bought YZF company. I can't believe that happened. I never thought they'd sell, or I never thought they'd buy it, and they bought it. Look at how much they paid for that. These are signs as well, because what that is a sign of is that is a sign that companies can't organically grow anymore. You see, and that's not always a sign, but when companies start gobbling up other companies at the top of the market, it is because they need to show earnings. They need to show growth, and they can't really show growth because organically they can't grow as much. And if they can't grow as much, what happens? Well, Wall Street comes and slaps them in the face and says, you need to grow. I need my investors to make money. I need to make money. So you need to grow. So how do they grow? Well, they go and buy another company and they put together a fancy investment banking deal called a merger. And that merger then allows them to grow. And that is what we call speculation. I'm not going to get into the derivatives because those are just dangerous if you don't know what to do with them. So we're not going to really talk about them. But I'm just saying there are so many things that we can look at on this chart and that I could tell you, I bet you back in 2000, these things, if you started going back and looking for those things and looking for those signs, you would have seen them all. I bet you if you went back to 2008 and you looked at all those things, you would have seen all those signs, mergers and acquisitions. You would have saw different telltale signs with the Fed. You would have saw a lot of things that now are perfectly evident and easy to tell, because guess what? We're looking in the past, but we don't live in the past, do we? We live in the now. And for those of you that are just listening to this, you can't see, but I'm wearing a watch that says now. Now is the only time that matters. Not the past, not what's coming in the future, because those are the unknowns. See, the past is a known, but it's a known we can't change anymore, but we can learn from it. You see, the future, we don't know. It is a complete unknown, so it's pointless to even think about it except for planning your next move. You see, what we can control is the now. And if Warren Buffett says buy low, sell high, and don't lose money, well, then it's not a very difficult thing to understand, is it? Now might be the time to start looking at getting out and taking those profits off the table, but not for long. You're just going to park them for a little bit, right? We're going to pull them into a parking spot, and all we're going to do is we're going to sit in that parking spot and wait. And that's all we're going to do is we're going to wait for the opportunity. Because folks, here's the thing that I can tell you. The biggest opportunities in your lifetime come when things are falling apart. Not when things are going up, not when we're at the top. They come when everything's crumbling down around you. That's when opportunity is born. That is when the smart and the wealthy and the rich, that's when they take action on opportunity, because that's when opportunity is at its greatest. Always and forever. That is where you can make unbelievable money. But if you don't position yourself, if you don't prepare yourself for the storm that is coming or will come sometime in the future, if you don't get this one now, you'll never understand what that means. Opportunity is now, and opportunity is coming, and opportunity was in the past. But what one of those three can you control? You can control right now. Focus on that chart. Focus on all of these charts. Do some homework. Go back and look at these and do what I did and just count years. That's all you're doing. Forget about the little bumps in the road because those don't matter as much. Just count the years between the big high and the big low, and then tell me how much this helped you figure out the secret. The secrets of the wealthy are right there in front of you. And I'll tell you who that wealthy person is. There he is, folks. Warren Buffett. So I know I went forward and then I went in reverse on this, but this is the conclusion to the hidden secrets of unlocking market patterns. I hope this was helpful for all of you. I hope you guys take this and use this information and don't get stuck in the patterns, because honestly, this one little training that I just did for you can change everything for you in the future if you take action now. Thank you all for joining me for this training. I hope it was good, and I hope you learned something from it. Now go out there and take action and start learning more and diving deeper into it. Thank you.